You're watching Bloomberg Quint, and we're in conversation with Ramesh Sopti of IndusInd Bank after the company has reported its earnings for the third quarter. Just a brief mention, net interest income rose 21%, net profit rose about 5%. The upside this quarter was the gains from the treasury side. The downside was the handling of the IL&FS account, or rather the weight of the IL&FS account on IndusInd Bank. Mr. Sopti is here with us to explain all those aspects. Thank you, Mr. Sopti, for speaking to us. Sir, the quarter broadly operationally continued with the trend that we have seen in the last few quarters. There's healthy growth in advances. Deposit growth has kept pace. You got a kicker from Treasury, but you got a bit of a hit from the IL&FS account.
Yeah, so I think if you look at the core flows on the headlines and the core operating profit, they have grown well year on year, and especially I think quarter on quarter. That trending is very important. So you mentioned net interest income is up quarter on quarter by 4% and year on year 21. Fee has grown well. Fee has grown 24%, and that does include an additional 100 odd crores that we earned on the earnings side. But I think the other elements of fee have also done pretty well. So the revenue line grew almost 7% quarter on quarter. Costs have been held quite well, although we are expanding branches and things like that. And therefore, operating profit was a very healthy 27% growth year on year and 7% growth. So I think the core still remains the same. And even if you come down to the profit after tax, year on year, of course, because of the additional contingent provisioning that we have made on IL&FS, quarter on quarter PAT grew by 7%, and I think that trend for us is the most encouraging trend, because that tells you the business as usual sort of profit.
Mr. Sopti, a bit more clarity on this IL&FS issue before I get on to slightly longer term trends. You know, in your release to the exchanges a while back, where you put out the disclosures, you had said 2,000 crore is the bridge financing to the holding company. Sir, I'm confused about how that has remained standard. Payments on that have continued to come in during the quarter. Are they now in SMA 2, or as in it's 60 days overdue or 30 to 60 days overdue? Where does it fall right now, sir?
So they are overdues, and you know, prior to October, there were monies held by all banks which were for servicing of the debt. So either in the form of escrows or in the form of debt service reserve accounts, etc., or fixed deposits, etc., monies were held by banks, and they were used to service this thing. So certainly these accounts are SMA status, and but they are standard. They were standard in quarter 2, they are standard in quarter 3. They may not be standard in quarter 4. But I think for us the position is that whether standard or not standard, whether money comes in or doesn't come in, we have provided in excess of what we would need as per IRAC norms. We have already provided enough for a substandard loan, and we have said that we will provide more based on our final assessment of the realizable value of assets in the holding company.
The realizable value for that 2,000 crore would be low, no sir, right now, because there doesn't seem to be much hope of a group-wide resolution plan. It looks like it is going to be the individual assets which get sold, in which case whatever exposure banks like yours have to the individual assets, you probably have more chances to recover that than the 2,000 crore bridge financing.
No, see, it was never a sort of bridge financing. It was a financing against the assets and receivables, and the rights money was meant to prepay in case it happened. So there are assets, our understanding is quite clear and our sensing is quite clear, that there are assets which are attributable directly to the holding company. Forget the operating companies. The operating companies and the SPVs are separate, where they are separate lenders and this thing. But we have reason to believe, and strong reason to believe, that there is a realizable value lying in assets attributed directly only to the holding company. So, I mean, it was not that if the rights issue didn't come, debt will not be serviced. The debt was to be serviced in any case, whether rights happened or did not happen. It was never classified as a bridge loan, but it has got sort of, in a way, transformed as a bridge loan. And it was otherwise to be paid in 6 installments starting of February. So I think there is what we have done so far is to very prudently make contingent provisioning, although it's a standard asset. And we have taken up this total attributable provision to the holdco to almost 30%, which is ahead of the IRAC norms in case you become substandard. And what we have said in the presser is that this quarter we will make further provisions linked to our final assessment of the realizable value, because at the end of the day, realizable value comes only if there's a buyer. And so what value are buyers willing to pay for the assets, and therefore what is the real value? And based on that, we will take a provisioning, higher provisioning than that. So we are committed to the provisioning to take it to a level that we are comfortable with, that we don't have to provide any more.
So by the end of Q4, sir, the credit costs associated with this will be over. Next year, fresh start, sir?
Yes, that is our intention, and that's why we keep sort of pointing out that you look at the underlying profits, and the underlying profit is actually indicated by the operating profit before these provisions are made, and you see how healthy the operating profit is. So we start 1st April on a new page, hopefully having made these provisions and put it behind us, and then look at the run rate of the underlying profit. Of course, added to that will be the Bharat Financial Inclusion income as well.
Okay, so quick last word on this issue and then moving forward. A bit of soul searching on why you did that bridge financing. If you hadn't done that so close to that group going under, to put it broadly, perhaps IndusInd would actually be fairly unscathed from this entire issue.
Yeah, of course, that's always hindsight. Hindsight has fantastic clarity. And this was seen as a short-term, low-risk sort of exposure. And it ended up being a longer-term, high-risk sort of exposure. And of course, it's, when it was given, not a single company in the whole group was in default. And there are all sorts of people writing all sorts of things. They have become hindsight experts. But there was the companies were also rated very highly, whether it's the holder company or the SPVs, etc. So I mean, I've said repeatedly, over time, that there is no such thing as risk-free banking. So it's low, medium, or high. It depends on how you assess it. And yes, we have said openly and clearly that there are learnings out of this, not only for us but for the whole industry, on financing of complex holding company structures, etc. So we hope to address this, put it behind us, and get on with life.
So how is growth looking across your portfolio right now? I think you're one of the first people to sound actually quite optimistic about credit growth starting to pick up across a number of your segments. Has that sustained? There is some worries starting to crop up on the economy. Anything that's reflecting in your books?
No, I think we are seeing pretty good underlying growth and a pull across the sectors. So so we are across the entire life cycle of a loan. I mean, we start with the microfinance and the S of the SME and the M and the large corporates and the PSUs and financial institutions. We do the whole lot, and we are seeing what I call a secular sort of a trend across. That's corporate. Then you have vehicle finance. Vehicle finance, even if the market shrinks because the NBFCs may not be financing, our market share improves, and it has improved. For instance, commercial vehicles, we have improved market share by almost 2%. So we are growing there by 30%. Non-vehicle retail, 8 or 9 products, they are a sub in terms of scale, and therefore growth rates are going to be high, and they are growing between 28 and 30%. So I think we are seeing across the board pull and across sectors pull. It's not linked to solar or transmission or this thing. So I think there is certainly, I think, towards the end of this fiscal, you will certainly see that this trend is continued, and it's pretty strong and secular.
And CASA, sir, continues to grow as well, so there's some potential. Is there some potential for margin improvement, or you're pretty much at the peak of the margins as you see them?
I think we are pretty much at the trough of the margins.
Oh, okay.
In the sense that we had a margin, this thing right at, at the peak we had a margin of 3 quarters ago we were 3.98, and we are now 3.83, so about 15 odd basis points. And we had said even last quarter that we see stability first coming in as the cost of funds and the yields start matching. The yields were sort of lagging behind the cost of funds, but I think that lag is now being caught up. We are seeing an increase in the yields overall, and therefore we see our outlook on the interest margin is stable or with an upward stance.
Okay. Where is your strategic focus, Mr. Sopti, in the next couple of years? Apart from, of course, succession, etc., which you've talked enough about, but in terms of growth, where is your strategic focus for the next couple of years?
So I think we have two clear parts of the bank emerging. One is urban and semi-urban, and then of course the second part is the rural this thing, and that part is now being buttressed by the addition of Bharat Finance. So I think there is while the urban semi-urban model continues to go along, this is where we do our corporate lending and things like that. I think there is a new frontier that we will address, which is the rural banking frontier. With the addition of Bharat, we will have a coverage which probably is difficult to match in rural India. 115,000 villages, something like 9 million customers. I think in a year's time, 2,000 odd branches of Bharat alone. So that is going to be a huge focus area for us. And I think the synergies that we will draw out of rural India have yet to be fully sort of baked in and appreciated. But I think that we now have an opportunity of addressing rural India and its growth potential like we never had before.
Sir, specific question, because you haven't mentioned your sort of gems and jewelry portfolio. I know yours is very different from what other banks do, but the RBI has also raised some concerns in the financial stability report about the health of that sector. Can you give us a sense of what you're doing, either de-emphasizing it or parts of it?
No, our portfolio is squeaky clean, Ira. It has always been so. I mean, apart from one inherited account, which was inherited 10.5 years ago, we've not had a single delinquency. And in the portfolio that we purchased from ABN AMRO, not a single delinquency in the 4 or 5 years that it's been with us. So we finance the creme de la creme of the diamond industry. And I think we understand and have a deep understanding of that industry, because we know that it's not about collateral and security, it's about the flow of cash. So there is a domain expertise there which gives us domain sort of leadership there. Our portfolio is been absolutely sort of clean, but we are aware that there have been delinquencies in parts of the industry, which has certainly impacted on banks. Our process of sifting the good from the weak, I think, has held up pretty strongly over the years.
All right, Mr. Sopti, I'll let you go. Thank you so much, sir, for your time. Thank you for explaining some of the issues with the numbers and also, of course, a broader roadmap for IndusInd Bank. Thanks for watching.